So hopefully everyone has been able to join now. Welcome everyone for joining us for today's webinar, Disappointed with Your Tax Bill. Before we get started, I just wanted to just give everyone a little bit of background of Hive, who we are, our philosophy, and then an introduction to myself and Connor. So I've worked for accountancy practices before. My role mainly consisted of calculating profits, disallowing expenses that weren't deemed to be tax deductible, arriving at a tax liability, usually delivering not very nice news to my client. So I felt like the advice that I gave was quite narrow and often based on historical information. So about 6 years ago now, myself and some colleagues moved to set up Hive business. So we wanted to be a multidisciplinary firm working only with dentists. We felt by focusing solely on one industry, we could actually offer wider business advice. So we have a whole chartered accountancy division, we have chartered tax advisors, we also have a full marketing agency and consultancy division as well. So myself and Connor are senior accountants within the accountancy team. So we spend all our time talking with dentists, not only ensuring they meet their compliance needs, so tax returns, accounts, that sort of thing, but we always also get involved in practice acquisitions, practice sales, implementing financial controls for them, forecasting, so turning business growth strategy into numbers, and of course optimizing their tax position. So today we're going to spend a bit of time looking at the tax calculation you receive probably at the end of January, maybe a little bit before, and seeing what you can learn from that, what action you can take now to not only help your cash flow position of that tax liability, but also look to optimise your position for the 2021 tax year. We're then going to touch upon some tools that can help you to optimise your position. We'll have some time for questions at the end. Appreciate that your tax affairs are quite personal, so I'll also leave you with myself and Connor's email addresses so you can make direct contact. Also worth noting that the information given today shouldn't be taken as tax advice. Tax advice is always specific to your circumstances and bespoke and needs to be moulded around you. So Connor is going to take us away by discussing how we can learn from our tax calculation.
Lovely, thanks Hayley. Afternoon everyone, thank you for all joining us today. Yeah, like Hayley said, I am going to take us through to start with just explaining really kind of what is involved in your tax calculation that you probably received from your accountant either in January or just before, how kind of the different types of income that you may have going on comes together to make up basically what you pay your tax on, and a couple of kind of important watch outs that you need to be aware of, and yeah, like Hayley said, how you can kind of work with what has gone and potentially make a little bit of a better situation out of things. So to kick off, yeah, this is kind of a standard tax calculation. This might be kind of an associate working in a practice. It may be a kind of sole trader practice owner who perhaps has some NHS income which makes up their self-employment, and maybe a company that has some private income in that's paying them dividends. But yeah, this might be kind of a position that is familiar for you. Might be something that you're, situation that you're in. So this person has 80,000 of self-employment income. It's important to note, obviously, that this is the bottom line profit figure that goes onto your tax calculation. So it's not kind of like the gross income that you generate, it's your income less all the allowable expenses that your accountant has deducted for you, like subscriptions, wages that you might have to pay, everything like that, to reach the very bottom figure that you get taxed on. This person also has £10,000 of property income, property profits that they've earned in the year, and then £10,000 of dividends from a company. So you add all of those figures together and you come out with your gross income for the year, which in this case is £100,000. After that, you get any kind of deductions and allowances taken off of your gross income. So in this case, we've just got the standard personal allowance, which is a tax-free amount of income that you can get each year. Currently it's 12.5k. You might also kind of have pension deductions on there, perhaps if you pay into like the NHS superannuation, or maybe any losses if you've got those brought forward from earlier years. So you deduct any kind of deductions and allowances that you have, and that comes down to your taxable income of 87,500 for the year. So that's kind of like the top part of your calculation. Before we get into kind of how that translates into the actual tax that you need to pay, it's probably worth explaining and highlighting first how this kind of translates to the tax bands. I do apologise, some of the black lines on this chart have fallen out of line a little bit when we pulled it across, but I can kind of talk you through kind of how it all comes out. So the orange bar chart in the middle is the total income, and then I've drawn across on here black lines to show the different bandings and when different tax rates kick in. So up to 50k, that is the total amount of gross income that you can get before you tip into higher rate. So anything up to 50k gross income, you're taxed 20% on self-employment profits, property income, and then the dividend rate in this band is 7.5%. Then from 50k up to 150k, that is the higher rate tax band. So in there, you pay 40% tax on self-employment and 32.5% on dividend income. Then if your income is kind of getting up to the levels of 150k plus, you then tip into what's known as the additional rate band of tax. So the rates go up again slightly. So you pay 45% on self-employment income and 38.1% on dividend income. I've also drawn another line on here, which I'll come back to slightly later on, which is a really important kind of income level that you need to be aware of, which is the 100k abatement limit. Basically, kind of when your income starts to tip over 100k, you, for every £2 that you go over 100,000, you lose £1 of your personal allowance. So that's £1 less of tax-free income that you can receive each year. Like I said, I've kind of got some figures and illustrations to go through in a second that show just how important that is. But yeah, when it comes to kind of tax planning, that's a particular point that me and Hayley always pick up on when we're discussing planning options with our clients. So using the example client that we went through before, that 87,500 of taxable income, this is kind of the perhaps the bottom half of the tax calculation that you've received from your accountant at the end of the year. This is basically just how it's split out. So non-savings income is the self-employment and the property profits. You see there the 37,500 at the 20% basic rate, and then it jumps up to the higher rate tax of 40% that I was mentioning earlier. After that, you get taxed on your dividend income. So the £2,000 is a tax-free dividend allowance that you get each year, and then the remainder in this case is at the higher rate of 32.5%. So all of that gets added up. 26,100 is the total income tax for the year. There's then a bit of national insurance to pay on the self-employed profits, giving a total liability of just over 30k. Another important point to note is the payment on account system. This is often a question that I get asked a lot, kind of what is the payment on account system? How does it work? Particularly if it's maybe like your first year of being self-employed, or the year before, perhaps you kind of were just getting started or the profits weren't as much. If you've had a bumper year of profits, much more than it was the previous year, then you're probably going to get stung with this kind of like large payment on account that you're not used to. Essentially, the system is HMRC trying to get you to pay on account towards next year's tax liability, with the idea being that when it comes to 31st of Jan 2022, the balancing payment that you need to make is much lower. If your income has kind of stayed stable, you will have already paid up for the year, and then you just need to make the next payment on account. But like I said, kind of if this is your first year perhaps being self-employed, then this payment on account system comes as a bit of a surprise, and as a little bit of a shock, because essentially you have to pay 50% of your current year liability in addition to that balancing payment towards next year. So in this person's case, they earn just over 30k, or they have tax liabilities pay, sorry, just over 30k. The payment on account is another 15k, meaning that their total payment due at the end of Jan would have been £46,000 in tax. I now kind of want to take us back again to the abatement limit that I mentioned earlier. Like I said, it's really important, that 100k abatement limit. is a really important figure to have in your head. It's what me and Hayley use when we kind of consider planning options, because as you'll see here, so now this person, maybe this is the following year, has had an increase in their self-employed profits. No other kind of planning was taken ahead of time. Maybe they only get their bookkeeping up to date once a year, perhaps, so they didn't really understand or know where their profits were heading. But essentially, their gross income has now gone up by £10,000. So their gross has gone to 110,000 for the year. What that means is that they're £10,000 over that abatement limit. So for that 10,000, for every £2 that they earn over, they lose £1 of their personal allowance. So they've lost £5,000 on their personal allowance for the year, bringing that down to 7,500, which means that their taxable income for the year has now gone up to £102,500. If we now look at kind of how that translates into the tax position and compare it with where they were before, you'll see there the original position, what we just went through, kind of how the tax is calculated. When you rerun those figures with the new income that they've earned, so for the extra 10k gross, what you'll see is that their payment due, so that is the effect of kind of the tax liability and also the payments on account impact, it's increased by almost 9k. So for the extra 10k of gross income that this person has earned, 9k has gone to tax essentially. This is because that kind of abatement limit is particularly nasty, because not only are you kind of having the higher rate tax that you have to pay on the income that you've earned there, which is 40%, as we saw. In addition, you're losing 20% that you were paying, or tax-free income is now being taxed at 20% down the bottom for the personal allowance that you've lost. So essentially, in that kind of abatement limit from 100k kind of up to 120 plus, there's an effective tax rate in that band of 60%, which is why I said it's so important that that's a figure that me and Hayley have in our head when we're looking at tax planning. And if you are kind of disappointed with your tax bill this year and it's higher than you had thought maybe, this might be one of the reasons that that's happened if you've kind of tipped over that limit. So you kind of might be thinking that might be a position that you're in perhaps, or it might be a position that you've been in the year before, and you might be thinking, okay, so kind of what can I do about that now that the year has gone and passed? There's a couple things that you can do right now. So one of them is potentially reducing your payments on account into next year. Obviously, given everything that's happened in the last 12 months, a lot of things have changed. If you're a practice owner, you might have had to shut the doors for 3 months. Particularly kind of if you are mainly private based, that income will have just vanished. So there's a lot that you can do with looking into the next year, assessing what your income is, and if things are set to be either considerably or slightly lower than they were this year, then you can elect and do a very simple claim that you can put into HMRC to elect to reduce your payments on account into the following year. It's really kind of, there's nothing too complicated there doing it, but the cash flow savings can be in the thousands just by making this claim to reduce your payments on account the following year if you don't think your tax liability will be as high. Another thing that you can do is there's time to pay arrangements that you can use to help mitigate the kind of cash flow of your upcoming tax payment. Time to pay arrangements have been around for a little while now. HMRC have always done them, but they're always quite difficult to get hold of. You kind of had to call HMRC and prove to them that you've kind of explored every other avenue of potential ways to pay your tax bill. Again, with everything that's happened, they've simplified the system. So if your tax liability for the year is 30k or less, you can now do a simple online form. You don't have to talk to HMRC. All you need is a government gateway account. You can use this online form, fill it out, and effectively spread your tax payments over 12 months rather than having to make one big payment up front. On the next couple of slides, I thought I'd just kind of, because I know the payment on account system can kind of be a little bit hard to get your head around. I thought I'd just kind of try and visualize what the impact would be of reducing your payments on account. So this might be someone's default position. In the orange, you can see the balancing payments. So that's the actual tax that you were due to pay for the year up to 5th of April 2020. And then on top of that, in the grey, you'll see that there's the next payment on account that you need to make there. And then in July, you have the second 50% as well, payment on account that you need to make. So this would kind of be the default position if you were to do nothing and leave things as they were. However, if you assess things into next year and saw that your income was going to be much lower, you can, as I said, elect and make the claim to reduce your payments on account. So that balancing payment stays the same. That kind of is what it is. That's been and gone. You have to pay that. But that grey bar, you can move that around and reduce it if you think your income is going to be lower. So yeah, hopefully this is kind of a nice visual to see just how much you can reduce those payments on account by. One thing that this person didn't do, as I said, kind of as we were going into it, is their income went up to 90k from their self-employment, but they didn't think of kind of any foresight or use any planning options. One thing that they could have looked at potentially was the level of dividends that they had from their company if it's one that they controlled. So I'm now going to hand over to Hayley, who's going to go through kind of different planning options that you can take, particularly with regards to dividends.
Thanks, Connor. Yeah, so as Connor mentioned, up until this point, we've been talking about how to optimise your cash flow position for the tax liability that's already solidified for the 5th of April 20 tax year. But I want to shift the focus now. We're a couple of months away from the end of the next tax year, 5th of April 2021. So really looking at what we can do to impact and optimise that tax liability. So depending on whether you're a sole trader or a company, there will be different considerations. If you're a sole trader, your financial year and your personal tax year are one of the same. So you'll always be looking at your profits to 31st of March, 5th of April. If you're a company, your financial year could be 31st of March, but it could be any other point in the year. However, the 5th of April is still a very important date, as when you are drawing income from your company, dividends, they are declared on your personal tax return, which ties into the same personal tax year. So you're taxed on anything from the 6th of April one year that you take to the 5th of April the following year. So why it's so important to sit and look back at your profit and dividend levels at this point in time is because of those tax bands that Connor took us through. So it's very easy for you to tip into the next tax band, be that higher rate, abatement, additional rate even. Just tip in and it has a massive impact on your tax liability. So there are some things that you can look at doing between now and the 5th of April. And then I'm going to look at some kind of more longer term solutions as well. So pension contributions are relevant for sole traders and for companies. They work in different ways. So if you're a sole trader, it has the basic impact of extending those bandings that Connor was talking about. So rather than only being able to earn £50,000 at a basic rate, there's the potential, depending on how much you contribute, to earn upwards of £60,000, and it's still fall within that basic rate band. If you're operating as a company, it doesn't actually have any impact on your personal tax position. It just means that the company can top up the director's pension pot, and it's classed as an expense for the company. So there's a corporation tax saving there. However, still ties in with the 5th of April because there are pension allowances. There's only so much you can contribute to your pension pot each year, whether it be you as an individual doing that or your company doing that for you. And again, the 5th of April is the deadline. CapEx or capital expenditure and the timing of when that expenditure is also another opportunity. So we would never advocate just spending for the sake of it to save tax, but if you're thinking about capital investment, the timing of when you do that, there can be some quite substantial tax savings. So if we take an example of a sole trader who is earning £120,000 a year, or forecasting that they're going to earn that for the 2021 year. If they were to be looking at a piece of equipment, say worth 20,000, by investing in that piece of equipment before the 5th of April, they're looking to save tax of 12,000 for that £20,000 investment. So it might be that it's optimal for you to do it now. It might be that your actual profits are going up next year and it's better to offset that capital expenditure against a higher earning level next year. But it's just a consideration. Another area of substantial tax savings are electric vehicles. So this is only relevant for companies, but like capital expenditure, if you're a company, there are 100% allowances for capital allowances for electric vehicles in year one. So there is a corporation tax saving straight away. However, there's also a substantial personal tax saving because it means you don't have to draw the funds from your company, pay personal tax on those, to then go and purchase the vehicle. The company can just pay for the vehicle and all the running expenses, and that's tax deductible. So to give you an idea, if the electric vehicle was, say, £50,000, you could be looking to save tax of 15 to 20,000 just in year one. So as I mentioned, slightly different considerations if you're a company. So yes, it's good to optimize your profit position using the methods we've just talked about, but there's also secondary consideration of how much are you drawing from your company, and what are your personal levels of income. So to take it back to first principles, just to explain how a company and the dividend structure works. So a company is a separate legal entity in its own right. It earns all the profits, it pays some expenses, it then has to pay corporation tax on its profits at 19%, so there's a lower rate there. And then there are basically a pot of reserves, there's some cash that's left over, and that's what you have options with. And with options come opportunity. So the director basically can make a decision. Does it want to pay those dividends out? When does it want to pay? How much? And that's where we can really harness those tax bandings. So we call it the 50k sweet spot. So if you're operating a company, the optimum level for you to draw funds at is £50,000 a year, because it's quite a cheap tax rate. Connor touched upon 7.5%. Obviously, if you need more than that, you can take more than that. But there are then other ways that we can look to optimize things. So it might be that you have a spouse or civil partner that has maybe no income, maybe some employment income of, say, £20,000, £30,000 a year. But what they do have then is unused basic rate band. So it's quite a straightforward process to restructure the shareholdings within your company to appoint your spouse or civil partner as a shareholder, so that then instead of you taking an additional dividend at maybe a higher rate, or maybe that's going to tip you into abatement, we can redivert that to your spouse. It is important to note that this all has to be done in real time though. It was quite common a fair few years ago to just backdate dividends to sign off the minutes, but now there is a Criminal Offences Act that means that you cannot backdate paperwork. So the assessment of whether the company can pay the dividend and the decision of who it's paying it to and how much and the date all needs to be documented on a dividend minute at the point in which it happens. So some foresight and some planning, a review of what you've drawn to date, how much you're going to need in February and March for your personal expenses. Should you take another dividend, needs to be taken at this point in time. So you might be sat there thinking, okay, I've got cash in the bank. It's probably about the same amount of cash as I had last year. I don't really know how much I've drawn to date, but I tend to take roughly the same amount each year. Not really sure what I can do now, what the parameters are. So our first bit of advice would be to implement, if you haven't already, cloud-based bookkeeping. So we are a big advocate of Xero. It's not the only one out there. There are similar packages, QuickBooks Online, for instance. You might have seen the adverts on TV. They're all much the same and have basically made bookkeeping and financial control accessible to business owners. The packages are cloud-based. They're really easy to use. They're automated. So when accountants used to do bookkeeping previously, it would be kind of a whole time of them typing up your bank statements onto Sage, doing weird and wonderful journals. But now it's just a case of linking your cloud-based bookkeeping to your bank. It pulls the information in for you, starts to build up a memory. So if you've got monthly direct debits, it will start to remember what they were. So it's designed to get you up-to-date financial information with as little input as possible. Having said that, the software won't do everything for you. The onus is on you to keep it up to date, to monitor your profit levels, to communicate those with your accountant, and to track how things are going against your strategy. So all of these bookkeeping software have a really great reporting function. So you can literally get your profit and loss at a click of a button to show you what's available there for you to draw, or what your profit is maybe for a particular month. So then you can try and work out, okay, well, I know February is going to be similar to November, so I'm going to forecast forward and see what my profit levels might be. And I also kind of want to move on to maybe a longer term optimization. So we've talked about some things that can probably be done between now and the end of the tax year. What I want to move on to now is reviewing your overall business structure and seeing if it's right for you, which will kind of take a little bit more time to implement, basically. So here we have the two most common structures that dentists operate as. We've got the sole trader on the left-hand side. As you can see, quite a simple structure. So this sole trader has made the capital investments it can, pension contributions, still left with £150,000 profit. So this individual then pays £60,000 in tax, leaving them with £90,000 in their pocket. So then if we compare this to a limited company, so the limited company has earned that same £150,000. It pays firstly corporation tax, which is that 28,000. Then what's left over, there's an option of how much to draw. So the directors have calculated that the individual, they wish to draw 100,000 from this company. So that 100,000, that's the dividends that go on the individual's tax return. They then pay £20,000 in tax. So you can see in this example, the same £150,000 has been earned. There's 48,000 that's gone to HMRC, leaving that individual with £102,000 cash available. Now, some of that is in the individual's personal pocket, but actually some of it's retained in that company wrapper. So there's 22,000 that's been retained in the company. So that then leads us on to some further areas that we can optimize. So operating as a company gives you different options that just simply aren't there with the simple structure of a sole trader. So we've touched upon appointing your spouse or civil partner as a shareholder, but there are also other ways that we could remunerate the family. It might be that your son or daughter does some social media for you, maybe monitors the website. You could pay them a salary, tax deductible for the company, no personal tax on you to get the funds out the company. There are also bigger opportunities, perhaps if you're still supporting your son or daughter through further education. There's ways to utilise that 22,000 to support them. Pre-tax debt and using a company if you're looking to buy your first practice is also a really big area of optimization. So it's very tax efficient if you're an associate to save that 22,000, literally just leave it there in your company each year. Say your plan is to buy a practice in 5 years' time, so you're just leaving that money in there to accumulate at such a point in time where you can use it as a deposit for your first practice, tax-free. And then also you could look to obtain any finance to buy your practice via the limited company. So in basic terms, what that means is that then you're having to make your debt repayments pre-tax rather than post-personal tax. So to put it into kind of numbers, if you were to get a loan of £100,000, you would save £25,000 in tax over the course of that loan. So you can see how big the savings are if you're looking to buy a bigger practice or maybe get finance of up to 500k, 800,000. Then there's also tax efficient transport, which we've touched upon, electric vehicle, but it could be that you're looking to buy a bike. There's also schemes for that. Tax efficient investments. So a lot of people think, oh, that 22k is locked away in the company. I want to take it out because I want it to be doing something for me. I want to invest it. But a company can make exactly the same investments as an individual can, be that stocks and shares, bonds. It's just a corporate investment, so it can still be earning you money and it can still be doing something whilst it's in that company wrapper. There are also insurances, certain types of insurances that only become tax deductible when they're structured correctly and via a limited company. So we can structure it so rather than you drawing those funds out to then pay your insurance, we can make the company pay for that instead. And there's other things like education. So if you're looking to do a master's course, for instance, you could use the surplus funds to fund that. So the way in which we review who's paying for what, is it the right level, what's the tax strategy, is a personal budget appraisal. So it's basically a way of us reviewing of that 100k that we saw in the last diagram that the individual was taking from their company. Where is that going? What are they doing with that? Just so that we can pluck out anything that perhaps the company could pay for. Or also quite a common example that we see is that someone will extract, say, £500,000 a month, pop it in their ISA, the personal ISA, earn a little bit of interest on it. But in actual fact, what they're doing is they're extracting that as a dividend. They're paying 32.5% to get their hands on that money, for them to pop it in a savings account that is earning minimal interest. So actually, they're better off just leaving it in the company and doing nothing with it, because then at least they haven't lost that 32.5% in tax. So hopefully what you can see is that there are definitely savings still available, and definitely ways to optimize your position. There's some quick wins that maybe we could look at before the end of the tax year. And then there's some bigger restructuring and greater savings to be made that we do have to work a little bit harder for these days. So that brings us to the end of the webinar today. I'm not sure if we've had any questions that have come in at all, Connor.
Yeah, we've had one as we've been going along. Someone asked, how long does it take to set up a limited company? So kind of depending on how you want to utilize the full savings, if you're a practice owner, the incorporation process itself might take a little longer, but actually setting up a limited company can usually be done within a day or a couple of days. So, if you're kind of an associate perhaps thinking, oh, maybe I need to get myself a company before the end of the tax year is up, is that possible? The answer is yes, you can set up a company fairly quickly. The things that might take a little bit of time is maybe setting up a bank account, stuff like that. But yeah, the actual process of kind of getting that form, getting it registered on Companies House, really doesn't take that long. Obviously, you want to make sure that you do it in the right way, to maximize some of the benefits that Hayley was talking through with the kind of spouse shareholdings and stuff like that. So I'd always recommend kind of discussing with, kind of like ourselves or an accountant, a professional, to make sure that you do everything in the best way possible. But yes, it is a fairly quick and straightforward process that you can do now if you don't already have kind of a company structure and you think you might be able to make some use of it before the end of the year. And yes, it is a very quick and easy thing that you can do.
Great. Any other questions?
Had that come in. Nothing so far. If there is any other questions and you don't want to kind of discuss it over Zoom, obviously, then that's mine and Hayley's email addresses there. So do feel free to take note and drop us a line if anything comes up, either this afternoon or tomorrow, if you've had a chance to kind of take in the information. We'd be more than happy to have a chat or get a call set up to discuss your individual circumstances in a little more detail.
Perfect. Well, thank you to everyone for joining us. And yeah, like Connor said, drop us a message if you do have any questions. Thanks.
Thanks all.